Chris Whalen, chairman of Whalen Global Advisors, author of the Institutional Risk Analyst blog, the very best independent analyst out there on Wall Street, and author of multiple books, including the second edition of Inflated, Money, Debt, and the American Dream, and a friend of this show, someone we love talking to every month. It is so great to welcome you back, Chris, and congratulations on the book coming out this Friday, May 16th.
Thank you, Julia. There's nothing like getting books done.
And you've written a lot of books, and this one was from 2010, and this is the revised second edition. And I just want to do a quick programming note. Y'all, Chris comes on the show every single month. I know you all love having him on, so I want to just encourage this audience, go order your copy today. Let's support Chris with the second version. I've already ordered mine. And Chris, we want the folks to go to Barnes & Noble, right?
Yeah, Amazon's been having some issues. The books are showing up. You know, it's so funny. I always do a test when things are coming out on Amazon. So my first book still hasn't shown up yet. But Barnes & Noble was great. They fulfilled in like a day. But, you know, the reality is I think 90% of the sales will be Kindles anyway. That's just the way the book market is.
Yeah, everyone just is doing their device. I've always been like an audiobook girl, so I will definitely get the audio version. But I did go ahead and order my version just because I want to support you. You support this show. Yeah. I've read the first edition. I'm going through the second edition. A couple of changes.
Books are great to look at, you know, but the audio book will be out in about 3 months.
Love it. All right. Well, since it's been a little while because we are a little off schedule, and I do want to get into the book, but let's just kind of frame up where we are today, because we've seen so much volatility in markets, the progress on tariffs. Now the S&P is positive for the year. So folks, we are recording on Wednesday, May 14th, 9 a.m. Eastern, before the market opens. But Chris, let's just kind of get your take of where we are right now as it relates to the markets and the economy.
Well, Julia, as we discussed a couple months ago, you know, we said the tariff thing was going to be a bit of a distraction, and it turned out to be the case. I think the markets have rebounded now that they realize that President Trump has a plan and that he does indeed intend to cut deals with most of the nations, including China. So, you know, the secret meeting in the basement of the IMF last weekend apparently got the U.S. and the Chinese talking. But I think, you know, the real issue going forward is going to be, what does President Trump and the Congress do with taxes? What do they do with the fiscal posture in general? I don't think Donald Trump is going to get his big reconciliation bill. Reading the tea leaves this morning, the reporting of the overnight activity. And I think he'll be lucky to extend the tax cuts from Trump 1. That's what I think will be the bottom line. Senate Republicans and, frankly, Democrats in the Senate are not going to go along with what the House wants to do. In fact, they've already said they're going to rewrite everything. So, you know, stay tuned.
Okay, that is a good point too, because there's going to be like possibly a holdup there. What do you think the pushback's going to be about specifically? Do you have any sort of prediction there?
Well, they need a couple of $1 trillion in cuts, and that's just not going to happen. Medicaid, Medicare, that sort of thing. There's so many members of both houses who are marginal, believe it or not, when it comes to elections, that they're not going to go there. And I think the problem for Trump really is that there's 4 parties in Congress today. You have the very conservative Republicans in the House, you have a few centrists, and then you have the Democrats in the House, and then the Senate's a totally different ball of wax. They are totally in disagreement with their colleagues in the House. So making this work is going to be a challenge, I think, Julia.
Yeah, it's a fair point. I do want to give you credit coming on this show. And you mentioned it earlier. You were the one who called tariffs a distraction. I think a lot of folks appreciate that. That episode went super viral on our channel. And did you make any moves during that time or anything you could share? I mean, I don't want to put you on the spot, but how did you kind of think about that time? Yeah.
I told our readers, I said, look, go long the SPOOs. I'm still long gold. I haven't taken that position out because long-term gold is going to continue to be a great trade. You know, unfortunately, nobody in Washington is about to embrace fiscal sobriety. It's just not going to happen. They want to give stuff away. And then the other thing was, you know, we were short dollars for a little bit. I closed that trade off, but that's going to come back too. You think of long gold, short dollars as kind of two sides of the same coin. But I think you want to be long the market because, you know, why do stocks go up in the United States? Because of inflation.
Yep.
Our banking system doubled in size over the last 16 years. Does this indicate low inflation? No. So the inflation is the national pastime. That's what we talk about in the book.
Yeah. And so is our addiction to debt as well. So let's talk about the book, because the first version came out back in 2010. I love the story about David Kotok and the canoe. When you guys were, I take it I was at Camp Kotok up in Maine, when you guys were fishing.
That's right.
So cool. Talk to me about the decision to come out with a second version. I know a lot has transpired in 15 years, but just curious, what was it, the impetus to do a rewrite? Not a rewrite, but another edition.
The first book was a bit of a mess. In 2010, we were all broke. I worked in the mortgage industry, so everyone was broke because half of the market was private and those securities had traded down to 20 cents on the dollar, Julia, you remember. So I went back to Wiley and I said, look, we should clean this book up, number one. I edited 20,000 words out of the front of it. We took the stuff about Henry Ford, which was subsequently published in Ford Men, talking about the Great Depression and everything, put that where it belongs. And then I added a new chapter for Ben, Janet Yellen, and Jerome Powell, okay? Because the last 16 years, as you point out, a lot of stuff has changed. When the book first came out, we were talking about inflation. People thought, wow, this isn't a problem. Remember, everything was fine. Today, inflation is in your face. And almost anything you talk about, banks, investing, asset allocation, all of these issues are now a function of the Treasury market. So I'm working on a blog post for later today, in fact, talking about the most recent report from the Fed on conditions in the Treasury market. And sure enough, what they found was that when President Trump announced his tariffs, the market kind of performed as you expect initially. Rates fell. It was, flight to quality, the normal scenario that we would expect, right? But then all of a sudden rates turned around and went up. And that basis trade, which is how we finance Treasury auctions, by the way, started to disintegrate. This was a very popular post, by the way, on the Fed of New York and also the Board of Governors website. And I'm going to try and decompose what this means because I think we're still in trouble. We're still basically depending on a bunch of hedge funds to keep the Treasury market functioning. And that's the chief concern of the Fed, not employment, not inflation, keeping the Treasury market open.
That's interesting. Okay. Tease that out a little bit. Folks, we will definitely want to link out if the post is ready in time that's going to be on the Institutional Risk Analyst blog. But the significance of this, because I feel like people just talk about the dual mandate, but it sounds like their focus is elsewhere.
Yeah, it is, because ultimately the Treasury and the Fed are alter egos for one another. Why do we have the Fed? Why did we have primary dealers, which we destroyed mostly in 2008? It was to help the Treasury market, help the Fed and the Treasury have a little separation between the two. But today we're going back to where we were in the 1950s, which is banks are going to become the primary buyers of Treasuries. And the market, such as it exists, is basically just hedge funds. There are no primary dealers that are willing to take risk, buy bonds, and then turn around and sell those bonds. The way we used to 20 years ago, Julia. When I worked at Bear Stearns, we sold bonds. Treasury bonds have to be sold. They don't just spring up out of the ground and jump into your portfolio. So, this is the reality. And the markets always evolve and change. That's okay. But the trouble is that the increase in the federal deficit is starting to become a problem for the entire U.S. economy.
That's interesting. So is the market showing signs that it's broken then?
It's dysfunctional in a sense that unless we start to reduce the amount of cash that Treasury takes out of the market every month, they already are the largest single borrower in the country. We're starting to see crowding out, something that, the progressive economists told us was no longer relevant 30, 40 years ago. Yes, crowding out is relevant now. Thank you. And the problem at the same time is that the banks like JP Morgan and the rest of them don't have enough demand for credit. So what are they doing? They're buying back shares and giving their shareholders back their money. That's fascinating. Jamie Dimon talks about this all the time when he's on talking about earnings.
Gold prices have been breaking all-time highs this year. But price appreciation isn't the only way to profit from owning gold. You can earn a yield on gold paid in gold without selling your gold or silver. Unlike dollar yields that can be slashed or even go negative, a yield on gold paid in gold means more ounces in your account every month, not paper. Monetary metals is revolutionizing the way people invest in gold and silver. Instead of paying to own the metal, now you can get paid to own it. Right now, there are opportunities for you to earn 4% on gold paid in gold in their marketplace. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning a yield in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. All right, I want to go back to something you mentioned when in the book, inflation being America's favorite pastime. Okay, so let me ask a very basic question. Often with the inflation discussion, it sometimes feels like, okay, what's the CPI doing? Kind of like month to month.
Right.
What do folks get wrong about the way they look at inflation? Because my read is it's going to be a persistent problem, but they'll say, oh, it cooled this month or did this month. What do you think folks are misunderstanding about inflation or how we think about inflation?
Well, the key issue for me, Julia, is that people believe that the Fed can manage this process, that they are in fact in control of things like interest rates, inflation in a short-term sense. But that's not true. The Treasury is really the key player here. Most economists, if you actually ask them, ignore the Fed's balance sheet. They ignore the interaction between the Treasury and the Fed financially. That's wrong. You have to pay attention to this. It's probably the most important thing out there. I would tell you that the changes in the Fed's guidance on the target for Fed funds is a secondary factor compared to how much debt the Treasury is issuing and whether or not the Fed is buying. Right now, the Fed is not buying, which means they're selling. What does that mean? It means that those Treasury bonds have to be bought by somebody else, investors. At the same time, as you know, Donald Trump and Treasury Secretary Bessent have been trying to reduce the amount of cash that the Treasury needs by reducing spending, laying off federal employees, doing a variety of things to try and get that cash number down. But I can tell you, because of my work with some of my colleagues in the blogosphere who track the Treasury's cash operations, it's a very complicated beast. And whether or not Trump cuts spending or not may not actually push the deficit down. You see it's actually up in the first quarter of this year. It's kind of almost on its own. It's got a life of its own. And that's why I think it's so crucial for more reasonable people in Washington and the House and the Senate to demand a cut in spending. You have to get this thing under control. Otherwise, we have to raise taxes. But that, going back to your question about the book, Americans don't like paying taxes.
No, going back to the history of the country.
Inception of the Republic. And that's why I wrote the book. I want people to understand how we got here.
Mm-hmm.
And, frankly, Donald Trump is trying to take us back to the 19th century.
Yeah.
He would like to see America less engaged around the world, more self-sufficient. Not that we're going to be isolationists per se, but he doesn't want us to have to pick up the tab for lunch all the time. And you know what? A lot of Americans agree with him.
In the book, I did highlight this part. I got the Kindle version as well. You make a comparison to President Andrew Jackson and President Donald Trump. So I think that's what you're getting at too, that Jacksonian age. Can you help me kind of understand the parallel here?
Well, when Andrew Jackson was elected president after having his first election stolen from him by the Whigs in Congress, he was opposed by just about everyone in the country, business interests. They saw him as a reactionary and a bit of a Neanderthal. But the fact of the matter was he was a hard money conservative in terms of fiscal issues, and he caused a lot of problems in the U.S. economy by forcing Treasury to be paid for taxes in gold. He wouldn't let people buy land from the federal government except with gold. So that caused deflation in the U.S. He also got rid of the central bank, We didn't have a central bank for almost 70 years in this country. We just had the Treasury. And again, this goes back to my earlier point. The Treasury and the Fed are one and the same. We pretend that they're different institutions, but they're really not. An asset over at the Treasury is a liability at the Fed, right? It's magic. So I think the Jackson analog is important because Donald Trump is a disruptive force. He is going against the grain, and he's trying to bury 70 years of progressive political action in this country, going back to the New Deal. That's what he's doing.
You point out like the Treasury and the Fed, they pretend to be different, but they're really one and the same. It sounds like they're not supposed to be operating the way they are then.
Well, the big change brought in by Ben Bernanke after the 2008 crisis was these massive open market purchases of securities. They call them quantitative easing, which is one of the new speak phraseologies that comes out of the Fed. The Fed's a progressive institution, let's remember. You don't see conservatives working at the Federal Reserve Board. So they tend to have a very socialist orientation, and they're facilitating the Treasury's debt issuance, I think, is ultimately a political action. How do you not have political consequences when you're bailing out the government, right? So when you look at 2020 during COVID, the Treasury market fell apart in March of 2020. It just stopped working. So the Fed came in and they bought it massively. That's really what they were doing. They said it was for COVID. They said it was to help the U.S. economy. No, it was really about keeping the Treasury market liquid. Because ultimately, how do we finance Treasury bonds? We repo them overnight. We sell them to somebody else, and they agree to sell them back to us the next day. That's how it works. So if that breaks down, Julia, the whole thing stops.
Yeah. Okay, let me ask you this. You mentioned Trump's effectively reversing like the 70 years of the progressive policies. What is that kind of, what does that shift look like? What does that mean? And I imagine that might be another reason why you're owning gold as well. Help me understand the thesis here. Yeah.
Donald Trump would like to see the private sector as the largest part of the U.S. economy and the federal government smaller. Federal government's more than half of GDP now, the total public sector, including the states. So I think what he's really saying is that there is not a long-term future for this country if government is going to be in the lead, like the European countries, like the Asian nations. The thing that makes America different and more dynamic and able to grow faster than other countries is the private sector. So that's where he's focused.
You point out in the book as well, like for generations, Americans have accumulated so much debt and obligations. And I guess we have been living beyond our means. Help me understand, like,
that's what it means to be an American.
Yeah, but I imagine that paradigm also changes. Or does it stay the same?
No, it can change. Look, even with all the debt we have, Julia, it's not an insurmountable problem at all. If you were to slow down federal spending for a couple of years and make some other changes, you can get this situation under control very quickly. I did a blog post a couple of weeks ago where I talked about how Secretary Bessent should allow people to go into the market and buy some of these low coupon securities that cause Silicon Valley Bank to fail and pay their taxes with them or pay tariffs. So you would go into the market, buy a Treasury 2% way below par, right? You'd probably pay 70 cents for it. And then you could turn around and pay your taxes, but you would get credit for par. You would get dollar for dollar because you're saving Treasury money. You're giving them their debt back early and they don't have to pay interest on it anymore. So there's a lot of ways that you can manage this situation and make it much better in terms of how much the government is a burden on the private sector. But let's be fair. The Fed has inflated our economy so much over the last 16 years that the banks can't even find enough business. When Jamie Dimon says he wants to give more money back to his shareholders, he's telling you that he doesn't need it.
That's interesting.
Isn't that remarkable?
That's such a good
Because
point.
the whole narrative since 2008 has been about risk. Oh my God, the banks are taking too much risk. The reality is they can't find enough risk to take. How about that? That's what we're going to post in the blog later today.
That's a really interesting point. I didn't think about that they can't find enough risk to take.
Yeah.
But can I ask you this? Like, if the Fed inflating our economy, because they've inflated it, have they left a cohort of that? Have they left a cohort out because of that? Like, it's like maybe some people can't take the risk.
Low-income Americans don't benefit from stocks.
Yeah.
So if you're an affluent American and you can own stocks or you own real estate, hopefully well-located real estate nowadays, that's different from being just somebody who works 9 to 5 and has no assets at all, because those people are getting killed. One of the reasons that, something you and I have talked about a lot is that the whole multifamily apartment sector is in so much trouble, is that consumer income has not been going up, but the cost of running an apartment building goes up every year. The politics of this are brutal because the progressives in states like New York say, oh, well, you can't have any rent increases. Well, what happens if you don't let the landlord keep up with his expenses? The building starts to deteriorate, and eventually they abandon the asset, which is happening in New York a lot.
I was going to say, what about like the decline in like household formations, the birth rate? It makes me wonder. And Chris, I've talked to you about this, like wanting to. Okay, I guess my biggest gripe is like what should be an entry level home, and I know prices are coming down because I've noticed that it's like $1 million, and it's like I don't think I want to pay $1 million. Like I don't want to pay $1 million for like an entry level home. I know it's terrible to say, but like I don't. Like it just feels like that part got inflated, and I feel like a lot of my friends feel the same way. It's just I never would have been like, oh, I'm going to be in my 30s and my options are way, way, way out, or $1 million starter home. And it's not like a mansion; it's a starter home.
I live in what is a perfect starter home. It's a bi-level, 4 bedrooms, 3 baths, rectangular shape, very simple to take care of, by the way. This house probably cost $150,000 when it was built in 1974. Today, if I put it on the market, I'd be well over $1 million. To your point.
Yeah.
So what does that say about inflation, number one, generally? And also, number two, the cost of building new homes. Because the demand really, and the supply constraints are in that bottom half of the market. Think, the average mortgage is about $400,000. So figure that home price average is around $500,000. Well, builders are not going to go out and build homes for $200,000 because they can't. It's too much cost. It's like the guy who's running an apartment building in New York City. Having a building, I don't care what building it is, there's a certain minimum cost. So if your building isn't big enough, if you don't have enough square footage to generate enough revenue to make it work, it's not going to work. So the real issue is not just existing homes and how much their prices have gone up, but what would it cost to build my little house today? Probably $600,000-$700,000.
Yeah.
That's crazy.
Yeah, it's crazy.
But the materials, the labor, the other factors that go in, the land, most of the appreciation for most existing homes and commercial properties is in the land, Julia, which really reflects inflation.
What happened to the market? Like, how did we get to where we are? Is it because it doesn't seem normal? Or
well, it was the Fed.
Okay.
No, listen, during COVID, the Fed dropped interest rates to 0. We refinanced 2/3 of all mortgages in this country in 18 months. It was, boom times for the mortgage industry, but that pushed up home prices double digits for 5 years. And nobody at the Fed, this has been documented now in the community, the Fed's getting beat to hell in the background by academics and others who are saying, didn't you think about the downside of doing too much with quantitative easing, how it would impact housing and affordability? They're getting crucified over this. And they should.
Yeah.
They did too much. Janet Yellen, Jerome Powell should have stopped years before they stopped. But again, remember, the bias of the Fed is very left-wing, very progressive. And the progressives have always believed a little inflation is good for working people. I used to argue with Billy Grider about this years ago, and they're wrong. But the politics of it, they sell this to people. And that's why today, when I'm working with politicians here in New York, I belong to the New York mortgage bankers, they don't make any sense, Julia. I can't even have a conversation with them because they don't want to hear it. Their narrative is not even on planet Earth. They're somewhere else now because that's how they've evolved their political conversation. And that's how they get elected. That's it.
Yeah. I mean, I'm trying to find it in the book because I was highlighting different passages. I can't find it, but you were talking about that 2% inflation and just how much it has, really eaten up the value of the dollar or our
Oh,
earnings.
sure.
Yeah.
That's right. 2% inflation will take half of your value over 20 years. So let's say you're doing the right thing. You're saving your money in your 401k. You're taking relatively conservative investments in your savings, right? You're losing ground because the Fed has decided that 2% inflation equals price stability. I don't know when they decided this, but they have that target now, right? On the other hand, if I'm in commercial real estate, I have to have at least 2% inflation a year or I'm in big trouble.
Let me ask you.
So the whole system is biased towards inflation, Julia. People make money on inflation in this country if they're astute. But there's an awful lot of people that don't play that game and they get crushed.
Good point too. Might be a pretty basic question, but looking at, when we look at our debt situation and I think we're almost to 37 trillion, 36 point something. I haven't looked.
Yep.
All right. Do we need some inflation to address that problem or that challenge? I think I've heard this before, but that you kind of do need some inflation to kind of help inflate your way out of it.
No, you don't want to ever become prone to deflation. In other words, you don't want to repeat the mistakes of the past and say, well, we're going to cut spending and that's going to save us. No, you do want to slowly inflate your way out of the problem, but you want to limit increases in spending to below the inflation rate. That's the tough part. We have plenty of assets in this country, Julia. If they made me Secretary of the Treasury tomorrow or an advisor to Scott Bessent, I can very quickly tell them how to fix this. It's not insurmountable at all. This is basically a baby boom problem. The baby boomers, fought World War II and then they had a party for 40 years and they didn't want to pay for it. So they left the tab on the table and they went home. That's essentially what happened. So can we fix this? Yes. The question is, how can we get the productive part of our economy growing faster and limit the public sector? Keep the progressives in a box if we can. And that's how we fix this.
Mm-hmm. And it might take some time too, I imagine. It's like a transition.
Of course.
Yeah.
Time is our friend. What did we learn in the Great Depression? The reason we had governmental action, the reason we created all of these entities that we have still today was to buy time. There was no 30-year mortgage in 1933. We had to create Fannie Mae. And that's really how we got out of that hole, was to buy time. Because time was our friend.
Yeah. Can I ask you a couple more questions before I let you go? Okay.
Sure.
I don't know where we left this the last time, but I do believe, I know we talked about your economic outlook and if there were a recession, if a recession was on the horizon. And I only bring this up because, this week we had a lot of recession forecasts. They were reduced, like from Goldman Sachs, they reduced their U.S. recession forecast to 35% from 45%. You had JP Morgan, who also reduced theirs. Its probability is now below 50. Barclays dismissed the recession risk entirely. And our friends at Kalshi, who are prediction markets place, and I like to look at their charts. I was just looking at the recession this year one right now as we speak. It's a 36% chance of recession. That is down from like the beginning of the month from May. It was at north of 69% probability of recession just from the betting markets alone on Kalshi. What's your take on like how quickly things move or these predictions, but maybe even your prediction where we stand today?
I am not a proponent of a recession this year at all. I think when you try and reduce recession or not to probabilities, you miss the point. The data is saying the opposite. So all of my friends out there in the blogosphere and everyone else who's been banging this drum about a consumer recession, well, guess what? In the first quarter, banks were still showing lower credit costs than they were a year before. So what's going on here? If there was a recession or even a hint of a recession, it was in the third quarter of last year. That's when Jerome Powell might have cut rates a quarter point, just to kind of throw a bone to the markets. But, I think the cuts they already put in place are probably all we're going to see this year. I don't see any rate cuts this year because the pain, to the extent there is pain in the U.S. economy right now, is on the commercial side. Commercial real estate, multifamily real estate, private equity, which is a complete train wreck. I think you're going to see and hear a lot about that later this year because pensions, endowments are all going to be taking big losses on private equity. Think about Harvard. Harvard not only has Donald Trump cutting back grants to the university, but their private equity portfolio is in the dumper too. So they can't liquidate any of that. This is becoming a big problem. And insurance companies are involved in this. But again, this is not a consumer recession. And I don't think you're going to see a consumer recession this year based on what I see from the banks in the first quarter.
So would it be in the commercial? And I think you and I have talked, that's a bit more of a silent recession, if you will, because that's just a different cohort that would be experiencing
that.
That's
right. Well, look, during COVID, did we worry about landlords? Did you hear one politician in this country talking about
I feel like
the
people
fact
usually
that
don't like landlords.
We're not getting paid? Well, of course not, but they didn't get paid for 2 years. So when you see some of these companies going into bankruptcy and being restructured, down the road, Julia, this will be a consumer issue because if nobody's taking care of the apartment building, or if it ends up owned by the city instead of by a private investor, guess what? The level of service is going to degrade dramatically. You see this in New York City. Go look at public housing in New York City. The city of New York runs over 500,000 apartment units that they own, and they take really bad care of them because they're not a developer. They don't know what they're doing. So when you have the public sector start to own large amounts of housing, guess what? The level of service and the overall quality of life is going to fall dramatically.
I just flipped over to look at the number of rate cuts expected on Kalshi, and the forecast is 2. But you're saying no rate cuts.
0.
Do we need rate cuts or just no?
No.
Okay, that's divergent from some guests I've had. Yeah.
No.
Yeah. What are they getting wrong?
The system has way too much liquidity. And not enough demand for credit. See, remember this, when the Fed was buying securities, deposits in banks grew. The reserves grew and the base of the banking system grew. But that doesn't mean that they have more demand for their products necessarily. So for example, credit cards, there's $5 worth of unused credit lines out there for every dollar in existing credit card debt. What does this mean? Consumers just don't need it. Same thing with home equity lines. You would think with rates this high, home equity lines would be flying out the door. They're not. They're barely growing. So my point is that you have a lack of demand for credit right now, and you have a surfeit of liquidity inside of most markets. And mostly it ends up getting invested in Treasury debt because that's the only thing out there. And high yield debt's done very well because, again, there's nowhere else to put the money. The reason people were able to fund a lot of dubious projects in the last couple of years, this goes back to COVID, was because of excess liquidity. So I don't know. I think we have to relearn a lot of economics because things do change. There's been a huge change since 2008 in how this economy behaves, largely because of the liquidity injected by the Fed. We're still not nearly done reducing that. Fed would have to reduce their balance sheet by another third before it would really start to tighten up, and they won't do that. They'll be worried about the functioning of the Treasury market long before that.
So interesting. Going back to commercial, is that like the new subprime?
Apartment buildings, yes. If consumer income's not going up, then how can landlords raise rent?
Yeah.
Okay. Progressives won't allow them to raise rent, but the cost of running the building goes up every day. So eventually you're going to have a problem where consumers are not able to, find a place to live. They're going to go to their politicians and complain. And this is why there's legislation now in Congress to raise the lending limit for HUD for multifamily apartments. They haven't raised it in 20 years. My question is, do we really want the taxpayer to be taking risk on these assets? The answer is they're going to have to, because either the states will end up owning these assets and subsidize them, or the federal government through HUD, Fannie Mae, Freddie Mac. There's a huge problem at Fannie Mae and Freddie Mac, by the way, in multifamily housing. You're going to read about that later this year. Huge corruption.
But I wonder, you piqued my interest. I wonder if more of these are in blue states, and does that also matter?
Mostly blue states, yes. Down south, development is still relatively strong, and there's also a big need. Texas, Florida. But I will tell you that existing assets in Florida, which tend to get discounted when people build new down the road, malls, apartments, what have you, existing assets in Florida are taking a beating. There's been some really large transactions recently with office buildings. There was one in Palm Beach that just went 30% below the last appraised value. So there is a lot of destruction going on here, but you don't hear about it because these are commercial markets. There's very little impact on consumers, and it's kind of complicated. People don't really even know how to talk about commercial real estate.
But you do. Wait, before I let you go, what's the Fannie thing? Do you know? Can you tease it?
Well, look, the government, when they become the lender of last resort, this goes to HUD, Fannie Mae, Freddie Mac, a lot of the assets that were financed over the past decade really are not very good quality. And in fact, the bank would never finance them. So the U.S. government has become the lender of last resort to a lot of older, smaller multifamily properties that frankly should get torn down. But in New York, the politics are to keep these assets open, keep people living there, rather than allowing developers come in, make a little money, and do what we should do. My ancestors were sandhogs. They used to build tunnels in New York 250 years ago. And a lot of those buildings from that era need to go, Julia. We need another phase of rebuilding and development in New York City that's equal to what Robert Moses did 100 years ago. But, nobody wants to talk about him because he's a very controversial figure.
I feel like you would make such a great leader, or I don't know. We would be in such great hands. I feel like if you ever did some sort of government work, I think this channel would love that. Well, selfishly, we want to keep you, but I don't know. I love having you on, Chris. We do like every single month. It's awesome. I could listen to you for hours. I've taken way too much of your time today, but let's have you leave some parting thoughts for folks. Please plug the book and let folks know. Everybody who's watching this video, I would love for you to go pick up a copy. It would mean so much. But yeah, Chris, the floor is all yours.
Well, I'm Chris Whalen, investment banker and author. I publish the Institutional Risk Analyst. I also write a column for National Mortgage News if you're really into the mortgage market. And, I'm always happy to hear from you on X and LinkedIn, RC Whalen. But definitely go out and buy the book. It's much appreciated, and I look forward to hearing your comments. Thank you, Julia.
Chris Whalen, chairman of Whalen Global Advisors, author of the Institutional Risk Analyst, and author of the book Inflated, Money, Debt, and the American Dream. It is always a pleasure having you on the show. We appreciate you being so generous with your time, all of your knowledge, your wisdom, and helping us learn. Looking forward to our next conversation, Chris, and congratulations on the second release of Inflated. We'll go pick up a copy.
Thank you, Julia. Have a great day.